You're now listening to the Tax Smart REI podcast, the number one tax podcast for real estate investors. Welcome to this week's episode of the Tax Smart REI podcast. Today we're joined with Logan Mohtashami, and we're going to be talking about interest rates, inflation, the 2024 election, supply and demand, and a whole bunch of other factors that may impact mortgage rates and your real estate investments at large. We'll be getting into all of that in just 1 minute. We'll be right back. Are you ready to prepare for 2025 with strategies that will save you money and optimize your real estate portfolio? Whole CPA and Tax Smart Investors is bringing you the Year-End Tax Impact, a one-day virtual event where it will be equipping you with the tools you need to finish the year strong and dominate the year ahead. At this event, you'll hear from top industry experts on essential topics like how the post-election results will shape your investments and your taxes. You'll also discover wealth-building strategies designed for 2025 and beyond. Plus, you'll learn year-end power moves so you can optimize your taxes before the clock runs out. And for our VIP investors, you'll get exclusive access to a tax strategy panel and even a live Q&A where you can get answers to your most pressing questions. If you're an individual investor or small partnership, this event is specifically tailored for you. And the best part, no travel required. You can join us from the comfort of your own home via Zoom. Don't miss out. Reserve your free ticket now by visiting www.taxsmartinvestors.com/year-end-tax-impact and arm yourself with the strategies and insights that could save you money, time, and a whole lot of headaches. With over 500 investors expected to attend, this is your chance to connect, learn, and prepare for a prosperous 2025. Again, just head over to www.taxsmartinvestors.com/year-end-tax-impact to grab your free tickets today. We'll see you there, but for now, we'll dive right into today's episode. And we're back. Logan, thank you so much for taking the time to join us today. Would you be able to give our listeners just a little bit of information on your background and how you kind of got involved in where you are now?
So this kind of was a big tragic accident. Our family's been in banking since the late 1950s, and I was actually a loan officer for 17 years starting in 2003. But somebody asked me from Benzinga to write about economics in 2010. One thing led to another. In about 2015, I decided, because there's so much bad information out there on the internet, that I'm going to do this in a more sophisticated data analytical way on the economy and housing. And my work became very popular. And then a lot of people know me for the work I did during COVID and today. So I'm right here now talking to you and touring the country and bringing thousands of my charts with me and trying to explain housing economics and the economic cycle itself in general.
That's a big undertaking. And I listened to a lot of your work on the Housing Wire, and it's pretty comprehensive. And you definitely know what you're talking about there. So kind of just diving right into things, I guess it makes the most sense to start with the Fed. Recently, a few weeks ago, the Fed did finally start cutting interest rates by about 50 basis points. How do you see that impacting mortgage rates, in the short term as well as perhaps the long term?
My always thing with mortgage rates is where the 10-year yield goes. And the bond market usually gets ahead of the Federal Reserve on what it does. So we had almost a 2% move lower in mortgage rates with no rate cuts. But we got to a key technical level in the bond market that I don't believe we should break under unless the labor market really starts to deteriorate. So what happened is, on the day that the Fed cut rates, housing starts beat estimates, retail sales beat that week, industrial production. A lot of the economic data actually started to get better right when the Fed cut rates. And then all of a sudden, Jobs Week came and 3 of the 4 labor data reports beat estimates. So the 10-year yield has gone up. And I kind of have like a line in the sand around 380 on the 10-year yield. So you're not going to get mortgage rates to really go lower unless the 10-year yield leads with it. The spreads can get better. That'll help some. But everything kind of looks right with where the economic data is and where Fed policy is, which is still very restrictive for housing in particular. So it's a shame because while mortgage rates were heading towards 6%, the data was actually getting better. We had the best 17 weeks in forward-looking housing demand. And then jobs report came and then rates just shot up 0.5%. And that's kind of been what we've been seeing since 2022. We get a little bit of progress and then we give it back on rates. And then eventually rates fall. So we're just kind of in this back and forth struggle with mortgage rates and housing demand for the existing home sales market, not for the new home sales market. New home sales are able to grow because they can get rates below 6% for their buyers.
That makes a lot of sense. So it sounds like when the Fed cuts rates, that's usually already kind of baked into the equation as far as mortgage rates go and the Fed is concerned.
Yeah, I kind of, when I go on tour, the first thing I ask everybody, does anybody like to slow dance? And then I show a chart of the 10-year yield and 30-year mortgage rates, and they've been kind of dancing with each other since 1971. So kind of what drives the economy, inflation expectations, where Fed policy is. Last year, I was known for, bringing out Gandalf the Grey. I said we should not break under 3.37 unless the labor market's breaking. Rates went up. So if you look at it in that perspective, mortgage rates make sense now with the 10-year yield. But the one positive story this year that wasn't the case last year is that mortgage spreads have been getting better. If they didn't get better this year, mortgage rates are over 7% easily today. And I'm hoping over time, as the Fed keeps on cutting rates, the spreads get better. And just by the spreads getting normal, 0.5% to 75 basis points, we can get under 6% mortgage rates without too much help from the 10-year yield. And that does make a difference in the existing home sales market.
That makes a lot of sense. And I know you mentioned a few times that the jobs report also, it seems like that plays a role. How does like job reports, how does that kind of factor into all of this?
So we have a kind of a rule of thumb here. Paper, rock, scissors over the last 2 years. Labor data over inflation data. The growth rate of inflation fell last year. It fell faster than what the Fed was forecasting. But people naturally assumed if the growth rate of inflation fell, rates would fall. But no, that kind of doesn't work where Fed policy is right now. They're restrictive policy for their own reasons. They're doing quantitative tightening. So there is no fluidness with the growth rate of inflation. But if the labor data got weaker, that can drive rates lower. If the labor market was breaking, let's say jobless claims were at 323,000, we are low 5% mortgage rates today. So I always try to get people to focus on the labor data and not revolve everything around the growth rate of inflation, because the Fed is still kind of have restrictive policy and they're slowly moving down to neutral. But the market has already priced in a lot of easing. So we just work off what the labor data says every jobs week each month, and the jobless claims data that comes out every Thursday.
What would you say is kind of your expectation for remaining part of this year? Say in the next 6 months, you expect them to cut more?
Yeah, a quarter rate cut is baked in the next 2 meetings and a few rate cuts next year. That's kind of already priced in mortgage rates. But as they keep on cutting rates, and assume that the labor data gets softer and softer, mortgage rates can go down. If the spreads get better, you could easily have sub 6% mortgage rates. That would make a huge difference, because the new home sales sector has been growing sales since the bottom of 2022. The existing home sales cannot grow sales, with mortgage rates above 6%. So that will make a difference. So we focus just on the labor data. And oddly enough, what had happened in the last 6 months, what usually happens in economic cycles is residential construction workers lose their jobs first before every recession. And this year, housing permits were down, housing starts were down, Home Depot and Lowe's warned. You had all the trifecta of all the things, because starts and permits were at recession lows, of the next wave of job losses coming from construction workers. And from March to July, there was no growth in that sector. In fact, the last month, June and July, was negative. But then the 10-year yield fell, mortgage rates fell, the builders' confidence grew, and new home sales grew, and permits, single-family permits, are rising again. So in some ways, the housing data on the new home sales side is preventing the existing home sales from growing more, because with that part of the economy actually picking up slowly again, it's preventing the construction workers from losing their jobs. And that's what we've seen in every single cycle. That's the labor trigger that happens before every recession.
With the end of 2024 right around the corner, now's the perfect time to start planning what moves you're going to make to optimize your tax situation before the year ends and get a head start on 2025. Whether you're looking to use the real estate professional status, the short-term rental loophole, cost segregation studies, 1031 exchanges, or anything in between, our team is here to help you through proactive tax strategy and planning, painless tax filing, and streamlined bookkeeping services. After helping thousands of investors save millions of dollars in taxes, we want to help you. So whether you're looking to finish the year strong or get a head start on 2025, what are you waiting for? Head on over to www.therealestatecpa.com/podcast to request a free 30-minute discovery call today. We're looking forward to learning more about your situation and how we can help. Again, that's www.therealestatecpa.com/podcast to request a free 30-minute discovery call. We look forward to hearing from you, but for now, right back into today's episode.
That's very interesting. Yeah, my father-in-law is a general contractor, builds a lot of homes up in way north Minnesota. He hasn't had a new build this year at all, which he hasn't had, I think my mother-in-law said, the last 10 or 20 years, something like that. So very interesting time.
Yeah, permits, single family permits have been falling all year long. Multifamily permits are actually at recession levels already, back to the levels in COVID. So housing starts are down. So it's one of these weird situations where the Fed policy is now, in a sense, fighting their inflation mandate, because going out in the future, if you don't produce more homes, shelter inflation has the ability to grow. So this is where I believe they're now. I mean, I was team higher rates in 2021 and 2022 because, things were about to get out of control. But there's a point to where you overdo it, and they're overdoing it. And instead of like getting easing policy to where we could get construction jobs going, building more housing to fight inflation in the future, we're just kind of slowly moving there. And the builders can help sell single family homes by paying down rates. It's much different in terms of buying land and apartment construction, because that's tied to short-term rates. So the cost of producing housing in that sense is too much. And you see a lot of permits being withdrawn that were there. So it's an unfortunate reality, but this typically does happen in economic cycles.
Yeah. One other thing I was going to ask if you could help not only me, but also our listeners. You keep using the word kind of the interest rate spread. Could you just kind of explain that and like how these things that are going on are impacted, what that means, like how does that benefit consumers and so forth?
Yes. So the mortgage spread is a very, very unfamiliar term to a lot of people. So assuming baseline everything off of the 10-year yield and 30-year mortgages slow dance together since 1971. Well, sometimes they slow dance really tight, and sometimes they slow dance a little bit far apart. The spread is the difference between the 10-year yield and 30-year mortgage rate. Normally 1.6, 1.8, some people would say 2%. What's happened is in 2022, the spreads went up super fast, which was very negative, almost a 3%. That means we're about 1.5% higher in mortgage rates than we normally would be, going back to the late 1970s. And even in the early 70s, spreads were under 1%. So that impacts housing more. But before the Silicon Valley banking crisis, the spreads were getting better. And then after the Silicon Valley banking crisis, the spreads even got worse and stayed elevated. But what's happened this year, and what traditionally happens, is when the Fed starts to get ready for its rate cut cycle, the spreads narrow down, right? That means mortgage rates today, just a good example, mortgage rates would be 75 basis points higher today as we speak if we took the worst spreads from last year. So right now you're looking at 7.375 mortgage rates. We're about mid 660s right now. So as the spreads get better, we've got about half a way to go. If spreads went back to normal, mortgage rates are under 6%. So when you hear people talk about spreads, it's that. And it's common in economic cycles. We see the spreads get worse during recessions or market stress. But when mortgage rates go up really fast, the business of doing mortgages is a little bit at risk, right? You pay an X amount of money to give a 30-year fix. If that loan gets refinanced quick, you're out of money, right? There's no more prepaid penalties. So the risk of doing businesses and the spreads widen out. And now they're slowly coming back down, which is positive. And that's something to think about going out, not only for 2025, but also for 2026. If we just get normal spreads, we could get sub 6% mortgage rates, which actually makes a difference in the existing home sales.
So as kind of mortgage rates decrease, which are maybe more dependent on jobs data than the Fed necessarily, is that going to ultimately lower prices, or do you think we're going to see sustained pricing or like increase in housing pricing?
This is a good question. If I look at the history of home prices going back to 1942, if I took 2007 and 2011, that period, out of the equation, we only had one negative home price year post-World War II. And that was in 1990, and that was only 1%. The history of nominal home prices declining, not very much. The early 1940s was super hot, like from 1943 to 1947 was the hottest home price growth period. In fact, the late 1970s, home prices grew faster than it did in the period recently, from 77 to 79 to 2020 to 2021. There are parts of the country that are more at risk of price declines, but what we've had is the supply and demand equilibrium is not in favor of any kind of big home price declines. And usually national home prices fall when there's major distressed sellers. Pretty much everything that we saw from 2002 to 2011, none of that is really here. Housing credit was actually deteriorating 4 years before the Great Recession. This is one of the charts that I like to show on my nerd tours. People were filing for foreclosures and bankruptcies, increasing in 2005, 6, 7, and 8, all before the job loss recession. So we had a credit boom and a credit bust. Foreclosures are near all-time lows. 30, 60, 90, 120 days are near all-time lows. Active inventory is not even back to pre-cycle highs. That explains why home prices increased in 2023 and 2024, even with the third calendar year of the lowest home sales ever. Usually you'll see stress in pricing in areas where you see distressed sellers. And that is where people, if they wanted to focus on, find the areas where you see a lot of distressed sellers, and there's where pricing can be effective. But it's just, we don't have a lot of history of national home price declines, even in the early 1980s. And I always like to compare this period to the early 1980s. The early 1980s, affordability was worse back then. We had less workers, we had more inventory, we had a recession, no price declines at all. Not a lot of people know this, but nothing. We had a flat year, we had a 1% growth year, and then as sales started to pick up, inventory started to increase, and prices increased a little bit more during that period of time. So we just don't have a lot of history, but we do know when you have distressed sellers and it happens in bigger scale, that's where price declines happen. Now, we did have 2022, which confused the hell out of everyone because inventory was low, monthly supply was low, but home prices fell in the second half of 2022. So the best way for me to explain that is people forget that early in 2022, home prices were going to have another 17 to 19% home price growth year. That's how hot we were in early 2022. And I always like to explain people don't know how low inventory got in America back then. We only had 240,000 single-family homes available for sale in March of 2022. Think about a country of 336 million with over 162 million people working. That's it. We had too many people chasing too few. It wasn't a credit boom or sales boom or anything. It's just literally you didn't have enough product. But when rates went from 3 to 7%, that second half of 2022, even with lower supply and lower inventory, the price growth to keep that 17 to 19% level couldn't maintain itself. We had some month-to-month price declines. And then what happened is everybody just assumed it was going to be housing 2008. When home sales stabilized, you go back to that supply and demand equilibrium. And that means that 2023 and 2024, home prices grew. Why? Because inventory is still low, monthly supply is still low, demand is stable. We don't have a lot of distressed sellers. So when you think about areas that you're going to see maybe price declines, places, Florida, of course, parts of Texas, New Orleans, places where the cost of housing is a little bit too much and you might have more distressed sellers in there. But on a national basis, we're going to be up again this year. If anything, my price forecast for 2024 might be too low. I was only looking for 2.3% nominal home price gains. We might end up between 3 to 4% this year. And this with the third calendar year of the lowest home sales ever and inventory increasing pretty much throughout the whole year.
That's interesting. What do you think is the biggest factor hitting the housing market right now? Is it supply and demand? Like that's actually going to have the biggest?
What we have now is that homeowners are doing really good. Like people just don't understand like the cost of living in a home in America for home buyers in the last 15 years, very low because their total wages rise, right? We always say, what's the best hedge against inflation on planet Earth? It's the 30-year fixed mortgage in America, right? This is why all the other countries hate us. They don't have this, right? So you have a fixed debt cost. Your wages rise more during an inflation period, but your debt cost stays the same. So your housing cost, in a sense, gets lower. So we have a lot of good homeowners and we don't have a lot of distressed sales. We have very low levels of sales. It's the third calendar. I'm not even joking when I say this. It's the third calendar year of the lowest home sales ever when you adjust it to the workforce. But like the NAR, a good example for your listeners, the National Association of Realtors has their active inventory data going back decades. Normally, we're between 2 to 2.5 million. That's normal. In the early to mid 1980s, it got up to 3 million. But in 2007, that was 4 million active listings. Today, we're at 1.35 million. We have a lot more people too right now. So homeowners are doing good. We have a very affordability issue, so it prevents sales. but that supply and demand equilibrium is still somewhat normal, right? I wouldn't say inventory is so low anymore. We have over 4 months supply now, but that progress or that systematical housing economic model has been here for 80 years. It's just that people have a life and don't look at this stuff like I do. So it's not shocking that prices are slightly increasing, but usually after you see a big price gain for a few years, the next few years are very, very slow price growth gains until, wages grow and household formation grows and housing becomes more affordable. And that's how it's worked post World War II. Only 2007 to 2011 was the anomaly period. And that was major distress sales. And I think the best way I always explain it is that for us at Housing Wire, Altos Research, we have our weekly live inventory data. It's the freshest inventory data out there. But we have something called a new listings data. And every single week, we get new listings coming on. These are the homes that come onto the market that do not have a contract right away. Well, 2023 and 2024 were the lowest new listings data ever recorded in history. So we don't have a lot of stressed sellers coming into the market. But in 2009, 10, and 11, I'll give you some examples. We're running between 30 to 90,000 for the last few years. That's a little bit under what we had pre-COVID. But back in 2009 to 11, we were running at 250 to 400,000 per week. Per week. These are distressed sellers coming to the market that aren't going to buy homes. 70 to 80% of sellers are buyers. So these are homes that are distressed sales. They go into the pricing, they bring pricing down. So that's my thing, is that I show people what happened back then, what's happening now. Oh my God, this does not look anything like that. And that explains why pricing is still firm, is that the supply and demand equilibrium is still balanced and there's no distressed sales. So as long as home sales are flat and or slightly rising, that's how national home prices have increased in 2023 and 2024.
Got it. Do you see anything on the horizon where there might be more distressed sellers, like a recession or something along the lines that would create the type of environment?
Traditionally, prices increase during a recession. In fact, it's increased in every recession except for 2007 to 2011 period. And we had 1 year in 1990 in that brief recession back then where we were down 1%. So what we like to do is when we see distressed sellers, we'll see it in our data first, and we don't see anything. Once we get to see a bunch of weeks of new listings growing above trend, that's something. But I think another thing for your listeners, when people talk about a foreclosure issue, why do home prices rise during recessions? Why does it happen? Well, traditionally rates go down, right? And demand picks up. But a foreclosure process from start to finish, starting from a 30-day, it's going to take minimum 9 to 18 months before that home comes onto the market. So foreclosures are still pre-COVID levels. So you have to wait for that supply to come onto the market and where demand is. So people go, well, and this is what happened during COVID. I wrote a COVID-19 recovery model on April 7th, said we're going to recover this year for the economy and housing. But people said to me, well, Logan, who's going to buy homes? Everyone's unemployed. And I said, okay, you have 20 to 30 million people unemployed. That's correct. You have 5 million in forbearance. That's 35 million people off the grid. I said, that's a lot. And they go, yeah, who's going to, oh, wait a second. My army behind me is bigger than yours. And this is how I explain it. I got 133 million people and 3% mortgage rates. Who are you kidding? Okay, these people are going to buy, as soon as they know they're going to live, they're going to buy homes. Housing demand came back 6 weeks back then. So whenever the next job loss recession happens, always remember, we're going to have the largest workforce in the history of America with lower rates. Over 162 million people working. So you got 2 to 3 million people that might lose their jobs. I'm going to have 159 million people on lower rates. My army is bigger than yours. My army wins. Right? So in that context, I think the downside to that would be, what if mortgage rates don't get below 6% and demand increases? And that allows supply to increase. What I call it is equity sellers. Over 40% of homes in America don't have a mortgage. The loan to values right now with people that do have mortgages are under 50%. So much nested equity. It's like $36 trillion of nested equity. The loan to values in 2008 were 85%. So it was much higher back then. But when you take the whole component, people don't traditionally foreclose on a house that they have equity. So we look at underwater homes. Underwater homes, 1.7% today, lowest percentage ever recorded in history. Back in 2010, fourth quarter, over 23% of homes were underwater. Much different marketplace, much different stress sellers. So when the job loss recession happens, we're going to look at the data. Jobless claims increase. We're going to look at the new listings data and we're going to see, does the supply and demand equilibrium break, or does this massive workforce that's going to get lower rates just engulf the distressed sellers like it's done in almost every single recession we've had post-World War II? And that's how housing economics works. You have to work off of that. But one thing we know for sure is homeowners are doing really good and they have a lot of equity and they're not underwater. So that whole 2008 model has to go away. Does not work here anymore. The credit markets are much different. And we have no more exotic loan debt structures after qualified mortgage. So we have the best homeowners financially on planet Earth, like for centuries. So what we have to see is if rates don't go low enough to offset any kind of distressed sellers when that day comes out there, we're not there yet.
You're making the housing market look really, really good, at least from what I'm hearing right now. So that's good to hear as a homeowner myself. One thing I just wanted to circle back on was the continued, decades long kind of trend of the increasing price in housing. Do you ever see that as like a bad thing? Like, is there anything that'd be like, hey, if this continues, but this doesn't continue, this is a bad thing?
How I described the housing market in 2021, people followed me. It was like, I was so concerned about prices escalating out of control that the whole media tour early in 2021 was like, home prices are about to escalate out of control. This is a problem. It got to the point to where I was calling it savagely unhealthy. So we went from the unhealthy housing market to the savagely unhealthy housing market. So I kind of have an affordability index model, and my affordability index model got screwed after 2 years. So because of that, the problem is affordability getting so stressed so fast is that once rates rise, demand's going to crash. And we had another period in time in history that happened. Late 1970s, the baby boomers now, they were the millennials back then. They were buying homes. Home prices were escalating out of control. Rates went up to 18%. It crashed home sales. Same thing happened here. Prices escalated out of control. Rates went up. It crashed home sales. So that's the bad part about housing, is that there are periods and times where home prices have the ability to escalate. But always remember, when you think about prices, you got to think of wages, wage growth, dual household. Like people always ask, how do we have 5 million total home sales this year and last year? Like who are buying? If you look at the NAR's affordability index, you need about $110,000 to buy a house in America. We're cheap compared to other parts of the world. Other parts of like Canada, Australia, like all those countries, they're so much more expensive to us. The dual household incomes, one person makes 90, the other person makes 70. There's your 5 million total home sales right there. The peak in the last decade was 6 million. So we're missing about 1 million marginal home buyers in the mix, but it does become unhealthy when prices escalate out of control. Like people are worried about forbearance and crash. Like, no, we have to worry about prices escalate. And that's the bad part about housing, is that there are periods and times where prices can deviate from wage growth and household formation, and then you get a crash in sales like we did recently, and it's hard to get out of it without mortgage rates going lower.
From an investor's perspective, it seems like there's good reason to believe the housing will continue to increase in price. Is now a good time, do you think, for investors to still be in the game? It doesn't seem like there's any reason for them to wait.
We have a lot of investors that use our product because we could price code every single zip code in a form that not a lot of people can see. But I would tell you this, with every single investor, you better know your area and you better be experienced on knowing where your area is. Now, there are a lot of investors, savvy investors, who know how to buy cheap homes in right spots and still make money. We still have people buying homes and flipping them with theirs. So you have to have the knowledge of your area and seeing where the demand is. This is why I think our work at HousingWire and Altos Research is really popular, because we're like 3-4 months ahead of every sales report and every price report. Like by the time people see it, it's too late. This is what we were doing at the end of 2022. We're like, oh my God, the housing market has already changed and everybody's talking about 20% home price crashes in 2023. When our forward-looking data changes, negative or positive, we go with it. So any investor is always going to have to realize you're going to have to look in your area and know how much you pay for that house. And a lot of people say, well, because inflation is rising still, home prices could rise. And that's what post-World War II, inflation is always increasing in America. And that gives it. We do have better demographics here in America than in other countries. Just to give you an example, the baby boomers, there's only 17 million baby boomers left working. Millennials passed them up in 2015. They're about almost 50 million. But Gen Z now is almost about to pass the baby boomers easily. So we have a lot of younger replacement workers and consumers. That's the difference of the US than other places, where other countries, they don't have a lot of population growth from younger people. China doesn't have it. Japan, 40% of Japan's population will be dead by the end of the century. And Europe doesn't have it. Well, we do. So in areas where you do see that population growth, household formation growth, there is that demand that's going to be there. At some point, demographics kills us all, right? Nobody has a Dorian Gray labor market. We all eventually, nature wins, we retire and we die. There's going to be a point in history in the next decade where you're going to have a lot of people dying off. And what their children do with their homes in whatever area is something to keep an eye on. We call this, people make this up, the silver tsunami. The silver tsunami was a premise in 2008. The first baby boomer hit 62 in 2008. And by 2015 to 2025, no millennials, they can't buy avocado toast or any houses. And all the baby boomers were supposed to downsize at once. And then 26 to 32 million homes come to the market. Home prices were, that was a terrible premise. But here in America, we do have a younger workforce and they're coming to the marketplace. So you have to know your areas to see, am I investing in an area that is cheap because there's a lot of old people, not all young? So always verse yourself, like every good investor does, verse yourselves with the data, and there's always money to be made. But if you're going kind of naked and not realizing and just working off the 30-year rate and just taking the national data, that's unsophisticated. With all the data that's available, you can break everything down to every single zip code, and it makes it easier for a lot of investors to make the choice that they do, whether they're in or out of the business of making money.
Hey Tax Smart investors, Thomas Castelli here, and I want to let you know that I recently started my own YouTube channel where I'll be releasing weekly videos on tax and wealth tips for real estate investors and business owners, and of course I'll be covering many personal tax strategies as well. But that's not all. I'm also going to be sharing the tips and lessons I learned by investing as a limited partner in real estate syndicates and funds, which you'll only find available on YouTube, and I'll be diving even deeper in Tax Smart Insiders. And lastly, in the not so distant future, I plan to cover estate planning strategies for real estate investors, and you'll only find that on YouTube. Subscribe today so you don't miss a beat by visiting youtube.com/@ThomasCastelli or by searching @ThomasCastelli on YouTube. Again, subscribe today at youtube.com/@ThomasCastelli. I'll see you over there, but for now, right back to today's episode.
Where can people get that data? You mentioned some data that people can get. Like, where is that? How do people find that?
So the Housing Wire website, I provide a tracker data every single weekend. It's active listings, new listings, price cut percentages, 10-year yield, mortgage rates. That's more for the national data. Altos Research, which is part of Housing Wire now, they can do demos for you and give you the unbelievable, like we keep all of our good stuff in-house. We only share the national data just to give everybody a kind of a taste, but we can actually break over 60 data lines within any single zip code. So the Altos Research website, you could go in there and get a demo of any zip code you want, and it gives you an idea where we break down all the current pricing listings. Like right now, a lot of people don't know this, but price growth was actually accelerating the last few weeks. The new pending pricing that even shocked us, but mortgage rates just getting to 6%. Nobody's going to know that data until like 6 months from now. So that's where you can get that through housingwire.com. And then you go into the Altos Research and you say, listen, give me a demo of this zip code here. I just want to see. And then you get to see all the jewels about, forward-looking pricing tied into every single data line with the places you want to go. So Housing Wire's website has the work. Altos Research has the data lines they can show you. We have a top 10 podcast, Housing Wire Daily. There's a YouTube page for it or Spotify or Apple. Twice a week, I go over and talk about everything, try to make sense of the craziness out there because it is confusing. If my Wall Street friends, if Fed officials I know are confused about everything, then the normal public is even going to be more confused. So there's a lot going on now, but you have to follow the right sources because there are crazy people out there on YouTube and TikTok that these are not housing analysts. They're what I call doom porn people, right? They don't forecast or have any kind of model. So always remember, follow the source, but make sure that source at least has 5 years of forecasting before you put any kind of weight into what they are talking about.
We're going to drop that into the show notes for everybody who's listening in right now. But kind of just to circle back on the demographic data, it sounds like from an investor's perspective, they'd want to look into markets where the millennials and perhaps Gen Z are kind of trending inwards, right? Or going to be there to support that market. Not so much the markets where the boomers are there now, but then they're going to be leaving and there might not be anybody there to replace them, which would push the prices down or stagnate prices perhaps.
When you think about young people, human beings are so easy to model out. It's very simple. They rent, they date, they mate, they get married. 3.5 years after marriage, they have kids. They typically buy single family homes in that situation. So you're not going to do that with baby boomers anymore, right? They're going away. So areas where you see Gen Z and millennials, because when we think about housing demand, you have the 5 pillars of housing demand. First-time home buyers, move-up buyers, move-down buyers, cash buyers, investors. Right. So the areas that have mortgage demand, right? Younger people coming in, that's where you get to see kind of young people buy and they get that house and they stay there for a long time. That's the thing about housing doesn't turn over very fast. From 1985 to 2007, it was 5 to 7 years for housing tenure. But now from 2008 to 2024, it's 11 to 13 years. In parts of the US, it's 15 to 18 years. I've lived in my home for 20 years. So you have to put everything into the equation. But demographics is demand, where younger people are going, moving to household formation, buying homes, having kids. Those are the places where housing demand can stay firm.
Do you see any sort of trends with that as far as like demographics, where people are moving to? I feel like a couple years ago, I kept hearing this kind of move to the cities, but anything there generally that you're seeing for trends?
So the work from home model changed a lot for housing because everybody had to live within like 30 or 90 minutes of where they work. So that work from home is actually, the percentage is falling, but there are parts of the country that it's cheap. And you also have to start to wonder, is kind of the Midwest and the Northeast, parts of that area, is it going to be the new next wave of migration? If climate change becomes too much for insurance costs and people's stress levels, is Cleveland, Wisconsin, Pittsburgh, are these places going to be the next migration where you don't have to worry so much about hurricanes or fires or anything in that? So migration trends are things that we always want to keep an eye on because that can move. I mean, look what work from home did. We had rich people in Orange County go to Boise, and boy, homes in Boise are cheap for anyone like that. So you that kind of inflation is not very healthy, but where migration goes, especially from higher cost states, that's a lot of money coming into an area that's really cheap. So you want to keep an eye, especially where people from California move to, because everywhere is cheaper than any parts of California. So migration trends are always going to be key. But, the kind of the Midwest to see, is that going to be the next? Is the move in the Sun Belt over and people are going to start to migrate there because they're cheaper? They could, raise their families. If they could get jobs, if work from home works, then you got something to work with there. But where people were moving out, you have to keep an eye on that kind of migration. And that's like Austin is a really good example. Austin home prices went up 76.5% in 2.5 years. That's crazy. But if Austin didn't get California people moving in there, that wouldn't have been the case. So they don't have that anymore. So it's really hard for Austin pricing to get stronger without the migration or without lower mortgage rates. So migration data is really key, and it's something that we have to focus on, especially over the next 10 years of what's going on right now in America.
Very interesting. Yeah, I'm in Minnesota. Tom is currently sitting in New York at the moment, but if you tell me that there's a huge migration to Minnesota in the Midwest and prices skyrocket, I would be very happy about that in some ways.
I mean, look what happened to Montana. Montana home prices went up like 50 or 60%, just with a little bit of migration to that area. Look what happened, So these places are not ready for kind of big city money to come in, because big city money is like, oh my God. Like, let me give you an example. A 1-bedroom condo in my neighborhood in Irvine, California, which nobody should use Irvine, California as an example, is $800,000. Okay. I can buy 2 homes in Minnesota for $800,000. But if somebody from here moves to Minnesota, they're going to think, oh God, this is cheap. I could buy 1 or 2 homes. So you always want to keep an eye on migration, especially from like New York or California or places like that. Even if Seattle, it's places like that where there are people with bigger pockets and going into areas that are just cheaper. And, People want homes and families. We love bigger single family homes in America. The tiny home marketplace never gets any traction because we like big homes. So you don't live in apartments. We don't really make apartments for families. So that's why single family housing tends to be stable. And the only thing that's holding sales back right now is rates. Right? Price growth has cooled down enough. Household formation, wages are growing. So if mortgage rates get below 6%, demand can rise. The builders shown us this because the builders are still growing sales. But a sub 6% mortgage market is what you need, and you need it to stay there. That's the key, is duration, right? If you get sub 6% mortgage rate, it kind of reminds me of the early 1980s because affordability was worse then. There's so much inventory. Mortgage rates went down 2.5%, sales started to pick up, and there you go. But we got really hit hard with the affordability in a very short amount of time, and housing has to work itself out in that regard.
Do you happen to see the election is just around the corner? Do you see that having any impact on housing at all?
Nothing really. I mean, I've looked at economic cycles and presidential cycles, and I know a lot of people say that, well, when Trump won, mortgage rates went up. Well, the 10-year yield was at 160 and it was forecasting better growth. So something like that, but it's not really, I mean, in all honest truth, economics is demographics and productivity. Kind of the rest is stamp collecting. So here, it really depends on what the economy is doing. So I always tell people the economy matters more than the presidential election. If the labor market is breaking, doesn't matter who the president is, rates actually go down. Housing, in a sense, disproportionately is benefited more. So just like housing was disproportionately hit harder, 2022, 2023, big job years, right? Big job growth. The economy was growing. Housing had the biggest crash in sales. Existing home sales have been in a recession since June of 2022. So rates matter, and the labor market matters for rates to go lower with Fed policy as it is. So I'm going to weigh the economy more important than the president.
That makes a lot of sense because only so much they could do to impact.
Yeah, I mean, and plus it's also one of the, a sitting president needs congressional approval for a lot of things and voting. There's all these other variables, but the economic cycle, in a sense, especially now, matters more. And if labor data gets softer, weaker, 10-year yields goes down, spreads get better, working from the lowest levels of sales ever, housing sales can grow.
Got it. And kind of just summarize, kind of like if an investor is looking at the market right now, it seems that if rates continue to drop over time, it will actually benefit the housing market in terms of the pricing will still increase at that stage, right? It's not going to decrease.
Yeah, you keep it simple. Lower rates, more demand. More demand is, even if supply is increasing, we've had a lot of decades where inventory has been increasing with sales. So if sales are growing, it's a positive. It's like I have these charts where I draw these black lines, and you could see like inventory increasing a lot in the previous decades and pricing increasing. I always encourage people, you should look at the pricing data from 1942 to 2024. People always get shocked about that. So if demand picks up and the supply and demand equilibrium stays stable, that is an effective pricing is better. For investors, of course, you have to know your marketplaces because there's investors every single week that choose something bad, don't know the marketplace, and it costs too much. So you have to verse yourselves with that. But there's a reason why prices usually rise during a recession. It's because rates go down, and the massive workforce, because most people are employed. Most home buyers and home sellers are employed during a recession. The group that has the highest unemployment rate in recessions are those that never finished high school. They're typically renters or part of a dual household income. And this is why housing tends to outperform in that environment because rates go lower. So that's how you should think about it. But again, with us, we always say we track the early looking data. And if something breaks on us, we'll see it months before the existing home sales report. And we've been very steady about this. Nothing was breaking on that side, really, in the last few years to warrant like big national home price declines. And the forward-looking data started to get better toward the end of 2022. That's why all those forecasts and like, here comes a big housing bubble crash, here never happened, right? And that's how we try to teach economics, because then everyone could see the supply and demand equilibrium. And that's the more important thing over the last 80 years with housing.
This makes a lot of sense. And this has been a very insightful discussion on kind of what really goes on and how things really work. It's not just like the headlines maybe you see out there in the news.
If it bleeds, it leads. It's doom porn for a reason, right? It sells, right? That's how it does it. I always say economics done right should be very boring. It's not designed to be this kind of sexy, fun thing. Problem is my academic friends are really stale and they don't really like make it fun to listen. So not a lot of people listen, but there's a way to talk about economics and teach it. And you don't have to be like, hello Bueller and something like that. You can basically make it where people can understand. And that's our job. That's why we think Housing Wire has the best data out there. We make it relatable. So then everyone, investors, real estate agents, mortgage people, I always say Uncle Dave. Every family has an Uncle Dave that tells you home prices are going to crash. Even we try to teach Uncle Dave that it's not Housing 2008 and just let the data talk, not the most fun thing, but let the charts do the talking. And when it breaks, but we're just quite not there yet.
Okay. The last question I have is, do you see it coming at all in the distant future, or are we still very strong online?
So when we see housing like really breaking, our new listings data will take off. And it will go vertical because we're at record low levels of new listings data. And this is why we always teach people every single week. And we've constantly said this, there's nothing in the new listings data. Now, by the time the new listings data is out, it'll take 3 or 4 months to hit the sales data. So this is why we stress our data is the fastest and quickest way. And as long as the new listings data stays stable, there's just not a rush of sellers, right? And that's why I always like to refer back to 2009 to 2011 period. We had 250 to 400,000 new listings per week for years. Here, during the last 5 years, it's been 30 to 90,000, right? It's been the lowest 5-year period ever. That's how we have home prices rise every single year during this period, even with the biggest crash in home sales ever, even with the Airbnb nonsense, even with this happening here and mortgage, all that. It doesn't matter because the sellers are in a good spot. And if you're not forced to sell and discounts and have it in scale, this explains why 2023 and 2024 home prices rose. There's parts of the country that do have distressed sellers. There's parts of the country that aren't back to the highs in 2022. But as a majority, inventory is still too low. The supply and demand equilibrium stale. Once it breaks, we'll see it first. We'll be happy to tell everybody our new listings data is taking off and we're starting to see stressed sellers, just not there yet.
Got it. And you mentioned housingwire.com. Is there any other places listeners should go to find out more information about the housing and how you guys could help them out?
If you really wanted to get bored out, my Instagram page, which is my name, my Instagram stories are just looking at charts all day, right? So we have thousands and thousands of people go there and I try to explain everything and that's open to the public as well. So the Instagram page really talks about not just housing, but economics. I'm an economic cycle person first, housing second. So we try to go over everything and teach it that way. That's more of a video format. Some people feel more comfortable visually seeing charts and having someone talk about it. And we do Q&As every Friday. We answer all the questions that anybody wants. But yeah, Housing Wire Daily, the podcast, Apple, Spotify, YouTube page, Housing Wire Daily, or Housing Wire YouTube page. But if you really want to get nerded out, my Instagram page, actually, every single day we talk about economics because I literally do not do anything else but this.
All right. Awesome. Well, thanks for coming on the show today, Logan. Again, it's been really insightful. I'm sure the listeners are going to get a lot of information out there, and it's good to hear the housing market is strong. And that's about a wrap for today.
Thank you.
All right, everybody. So we're back with a quick debrief. We don't usually do these, but there's a lot of information, a lot of great information that Logan shared with us today. And we didn't get a chance to really touch on taxes. So we want to kind of touch on some of the tax elements there, especially around capital gains. If your homes that you own continue to appreciate in value. So we definitely want to touch on that. But as a quick summary to the episode, Ryan and I were just talking about afterwards. Basically, long story short of it is that interest rates do play a major role in housing and prices. And as rates fall, housing does tend to rise, assuming the demand is there, which the demand is going to be there depending on your market based on demographics and migration patterns. But really the bigger factor to consider here is really the labor data and whether or not we'd enter a recession. And if we do enter a recession, what happens is, from what Logan was saying to us, is that their rates are actually start to get cut even deeper, which continues the demand for these houses going up and the prices, because most of the U.S. is still employed during the recession. Yes, there's a segment that is unemployed, but like Logan said with the Army, his Army is still bigger, right? The people who are employed still bigger, and they're going to go and buy up the housing anyway. And right now, it doesn't seem like we have this supply is not getting fixed, right? There's still like an undersupply of housing. So housing will still continue to increase. It's kind of what I got, as a summary note there. Did I miss anything?
No, I think that's good. And I'll just hop in with a couple comments on some of the tax things that you and I were discussing as well. So we're trying to think like, okay, of this episode, what are like the main tax things to maybe take out of this? And like you said, it's kind of exit strategies. As you think about one, right? Logan is, I think, primarily talking about obviously the whole housing market, and he did a good job of kind of explaining. I think he said like there's 5 different type of buyers. You've got those first time, increasing, decreasing investors and rent or something like that. But the point is like as we think about where housing prices are going, interest rates probably continuing to decline, like he said, a couple, quarter basis points decreasing throughout the next few months. It seems like you're thinking about an exit strategy. So if you're just a homeowner, personal residence, right? We've got the Section 121 capital gain exclusion.
Right.
We've talked about that a couple times. So 250K, right? Capital gain if you're single, 500K if you're a married couple. So keep that in mind for your primary personal residence, right? That's always something that you can evaluate. And then for investors, like a lot of you, pretty much all of you listening, right? We've got obviously a whole episode where Tom and I think it was 7 exit strategies, Tom, if I remember correctly.
7 exit strategies to destroy your capital gains taxes.
Exactly. Fantastic name for that. But the point is that you've got things like, right, 1031 exchange. We've got kind of what we call the 1031 light or the lazy 1031. You've got options there in order to think through, hey, I've got this sale. What might I do? And as you're thinking too about, okay, if I'm going to use something like a 1031, okay, just know you got to go buy a new property. And if prices are also increasing, they're increasing not only good for you on the sale price, but also probably for the acquisition price, depending on the market where you go. And he was kind of talking about, okay, if you're going from California to Minnesota, right, kind of the Midwest, got a very big price discrepancy there. But point is really kind of the main highlight there. There's a big opportunity for those of you who are sitting on a lot of equity, like he was talking about. Loan to values are quite low historically, and there's a ton of equity in homes, including, I think, investors, rental properties too. So you've got a lot of people who are going to be considering, what do I do about this gain? When do I do this? What are my options? What makes sense? And there's going to be a whole lot of things. So go listen to that podcast episode a few months ago. I think that was May, if I remember correctly. But any other comments you would say, Tom?
Yeah, no, I mean, I think that's about it. Really, at the end of the day, there's not too much to talk about from a tax angle here, outside of the exit strategies. And if you do want to continue to hold your property, because it does seem like, again, it's market dependent. You want to make sure you're in a market where, you have Gen Z and the millennials kind of coming in, staying in, and not in a market where the boomers are leaving and there's going to be no one to replace them. So,
Right.
If you believe your property is going to continue to rise and you do eventually want to sell that property, you do have to look at the exit strategies, which you mentioned, Section 121 for homeowners, and then, the 1031 exchange for investors. And, I'll just leave the last comment. I'm curious to see how the lazy 1031 exchange or the 1031 exchange light, how that strategy is used as we kind of go through with the phase out of bonus depreciation. We know the
100%.
bill was killed by the Senate, so it's not coming back for 2023. And it really, at this point, I think it just depends on who gets into office in November, but also how long it takes for them to, assuming Trump comes back and assuming he wins, how long it would take him to get 100% bonus depreciation, whatever other tax plans he wants to get implemented, actually through Congress, through the entire 9 yards to get it back up to 100%. Or if Kamala Harris wins, it sounds like she's going to let those tax cuts expire, which could hurt the ability to use that one specific strategy, making 1031 exchanges, taking back the crown of like the number one strategy to use. So exit's really just something you have to think about.
Yep. Awesome.
All right. So that's going to be it for today. If you are looking for a new CPA or CPA firm, now is the best time to start looking, especially if you want year-end tax planning. We're already it's going to be 10/15 when this episode releases. That's the tax filing deadline for individuals. And that behind you, you really want to start looking at what moves you could make at the end of this year, and also start peeking over to 2025 and start looking into what you can do there too. So you want to get that stuff moving sooner rather than later. I know we always have a huge rush at the end of the year, and we want to make sure that if you need assistance, that we're able to help you. So you can go to www.therealestatecpa.com/podcasts to request a free 30-minute discovery call to see how we can help you. We'd love to learn more about your situation, have that discussion. So again, that's www.therealestatecpa.com/podcast. And of course, we are always looking to add new team members to our team who have real estate tax expertise and accounting as well. So if you are interested in joining a firm on the cutting edge that's experiencing rapid growth with a lot of career progression ahead of you, with a lot of room to grow for yourself professionally, send us an email at onboarding@wholecpallc.com with your resume and why you'd want to work with us, and of course, which position you'd be seeking. We'd love to hear from you, and who knows, maybe one day you'll be here as a guest on the Tax Smart REI podcast. That is it. Signing off for today.